Mike, what makes you, yet again, bearish on a year when everyone else is finding a lot to be bullish about?
Well, look, I think it's really more about the stock picking, which is really what this year's been about, too. The average stock has not done particularly well. It's kind of been a strange year in that regard. Our earnings forecast for the average stock has turned out to be, dead right, and same thing for the average stock. And then we've had these, 10 or 20 or 30 stocks which have done extremely well, and they've done an incredible job of cost cutting in particular, which has driven the major average, the S&P 500 earnings up in a way that we did not project. And that has been the difference. And we think that that dynamic will probably persist next year, at least for the first 2 quarters, meaning smaller, lower quality businesses are going to continue to struggle. And then maybe by the second half of next year, when we see actually inflation bottom, ironically, that's when the earnings will come back. And I think that's been the trick. I mean, if you think about this year, inflation's been coming down, which usually is unequivocally good for bond yields. It's also good for disinflationary assets. It's not good for inflationary assets, which are basically small cap stocks and generally average stock. The average stock does better when inflation is actually accelerating. And I think that's been the trick this year. And most people got it wrong, quite frankly, because there were many people recommending, small cap stocks and financials and cyclical stocks, and this just don't work when inflation's coming down.
Mike, what you outlined, though, raises a question about the 4,500 target on the S&P at the end of next year. Is that assuming the big tech can't keep leading, that essentially there might be a recovery of some of the other stocks, the smaller caps, but that there will be at least some stasis for the big tech names that account for the lion's share of a lot of indexes?
Well, that's right. I mean, basically, this year has been all about multiple expansion, and this is in a year also when rates have gone up for most of the year until recently. So that's a combination that is unusual, as you know. So, our call at the beginning of this year was that rates were going to rates had normalized, quite frankly. They were going to continue to normalize, and then therefore multiples should normalize. So the real difference between our price target this year and what's transpired has been all multiple. We thought the market would close the year at 17 times earnings, which seems to be a fair multiple in an environment with 10-year yields north of 4% and some sort of level of risk premium. But instead, multiples are 19 and a half times. So all we're saying, Lisa, is that multiples will adjust this year. Earnings will be fine still for those large cap companies, but the multiple offset probably has them churning in place. And there will be some, obviously, that can continue to deliver better earnings growth, but it won't be all of them. It won't be as broad because that cost-cutting story isn't going to be as easy given the tougher comparisons on that front in 2024.
One reason why people are getting increasingly bullish, led by Ed Yardeni, who's gaming out 6,000 by 2025, is that yields are coming in. People do think the Fed's going to cut, that we are seeing rapid disinflation, and that this is all happening without material weakness, that we actually are seeing a normalization, a transitory, that nobody wants to say the T word. How much do you have to see more to be convinced of that kind of argument, giving a tailwind to all stocks, including those that that seem to be at pretty high multiples?
Well, the reality is that we're still out of supply of labor. It's going to be very challenging for us to see a acceleration of growth. We could see a flattening of growth, and that's basically what our economic forecast is, a very unexciting economic backdrop next year, called 1 to 1.5% GDP growth. It's interesting, not to pick on Ed, but I don't remember Ed talking about fiscal spending the way it's been this year. Nobody did, including us. And that has been the story also of 2023, which has buoyed a lot of the economic data, which ironically has then hurt margin pressure. So, I think 2024 is going to be a year where fiscal spending normalizes, monetary policy normalizes too. We may see some interest rate cuts, and there absolutely will be a transition for businesses that have already gone through that pain. The question is, can it be broad? Can it be in a way which takes multiples higher again, or at least keeps multiples where they are? If you were to ask me, in a broadening, healthier economic environment, multiples will come down as earnings normalize, right? You're not going to pay, a 19, 20 multiple on numbers that are now higher. So we do have a very bullish view on earnings for 2025. We have $266 Okay, should I pay a 20 multiple on that after you've already seen the recovery in earnings? I would argue no, and I think that's going to be the trick in 2024 is balancing, once again, multiples with where the earnings growth is better and where it's worse. And it should broaden out. It should turn into a broader market, but we think that's a second-half story, not a first-half story.